Welcome to another weekly market insight call where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this week is Chris Ahrens as often, and Joe Foster from Van Eck, who Joe brings a unique perspective, developed over a 40-year career, including experience as an exploration geologist, so he knows a lot about rocks and probably some metals too. When not traveling around the globe and visiting mine operations, he can be found writing his widely read monthly update, speaking with clients and journalists as a leading industry expert. And he's also weaving in and out of New York City on his bike. So I think the last couple of years you've probably been safer, but it might start to be getting a little bit more hectic, Joe. Are you being safe when you're weaving in and out in traffic in New York?
Well, I've had my share of accidents, that's for sure, but nothing serious. No, it's kind of amazing all the bike lanes that have gone on. They put in the city, so it's getting safer all the time.
That's good. Yeah, we definitely are starting to see some bike lanes here in St. Louis as well. So why don't you open us up,
Let's
Chris?
kick it off with geopolitics. And we do a weekly show, and so for a while we've been talking about that big move up in commodities at the end of February, and they start pricing in, a little bit of that war premium. We're seeing that coming down, right? Precious metals almost entirely have lost some of that gains, but some of the baskets of commodities are still elevated. How do you see this playing out the rest of the year for commodities and precious metals?
Well, for commodities in general, I mean, if you didn't think we were in a commodity super cycle before Russia invaded Ukraine, then you have to think that we are in a super cycle already with the shifts in demand patterns, the shift in supply, the fact that commodities prices have been rising, yet the producers haven't really been increasing production much in this cycle. So we're not seeing much of a supply response from the higher prices. And with the commodities from nickel and PGMs and soft commodities that come out of Ukraine and Russia, now we're missing that supply as well. So I think we could be going into another super cycle for commodities going forward. Gold's I guess I don't even think of gold as a commodity. It's to me it's a financial asset. So what I just said about commodities, I mean, gold's a little bit different. It's got different drivers, but what I said about supply is similar for gold. I mean, the gold miners have not been ramping up production in this cycle like we've seen in past cycles. So supply is constrained in gold as well. And then, we have investment demand driving gold in this type of an environment.
So then whenever we're thinking about that Russia-Ukraine crisis, and I don't want to be like on the late night commercial selling gold here, but I think there's some concerns or looking out and see what Russia's strategy appears to be. You're talking about this super cycle with commodities, or they would become more valuable. And it appears that Russia, one of their strategies is to link their currency more closely with commodities. And there's even this quasi link with gold. It doesn't go both ways. So I wouldn't call it a gold standard, but they certainly are trying to come up with an alternative to SWIFT. Do you think gold plays a role here, or does this look good for gold whenever you start to look at how other foreign players are acting in this situation?
Russia has been preparing for this moment for years with regards to gold. I mean, their central bank has been one of the top buyers of gold for many years now. I mean, they weren't buying last year. They stopped buying, I think, in 2020. But prior to that, they were one of the top buyers. Russia and China both. When you look at reserves, gold as a percentage of their forex reserves. Russia has the highest level outside of the Western nations like the U.S. and Germany. I mean, they've got, I think it's roughly 20% of their forex reserves are in gold. That's far higher than any other emerging country. And so, yeah, I think they want to have a lot of gold on hand to back their currency if needed, or to create a currency regime that is in large part supported by commodities and mainly gold.
One of our previous market insights, we kind of went over the triangle of being able to convert your ruble or your gold to ruble, ruble to dollars, dollars back to gold, and wondering whether it would only go one way, but could this be a play to try to drain more gold out of the West towards the Russian central bank?
I don't see it as an effort to corner the gold market or drain gold out of the West. I think it's more a case of Russia and China too. I mean, we can talk about both in the same breath here. Mm-hmm. They want to have an alternative currency system. They want to get off the dollar-centric system. And in order to do that, you've got there aren't very many currency reserves. I mean, you have currency, you have gold. There's really, when you look at monetary reserves, there aren't very many choices. And you've got to go to gold if you want to establish an alternative currency system. You need a stable store of value to back your currency. And I don't think any country could accumulate enough gold to 100% back their currency, but they could create kind of a fractional system where you have enough gold that gains the respect, call it, of investors in other nations, that gives your currency the level of respect and financial backing that it needs to exist on its own. So I think gold is part of their efforts to somehow create that alternative, that currency alternative to the dollar.
Are you seeing any appetite for that anywhere as far as a high probability of moving closer to a gold standard, or you think that's still just pretty low probability?
I mean, the dollar standard is just so overwhelmingly established around the world. If for an alternative system to emerge, I mean, it will take years, if not decades. But I just see Russia and China are taking the first steps, and they're so limited in how far they can go because they're not free market economies. They have currency controls and restrictions. They don't, especially China. They don't really have a truly free floating currency, so they're handicapped. I'm not sure they can ever achieve what they would like to with regards to their currency. So I think we'll be with a dollar-based system for the foreseeable future for sure.
Yeah, I would say that you're not going to see a gold standard. They'll always give you their currency for gold, but I don't think they'll ever give you their gold for currency. So, so I think that's the crucial point. And as you made clear, no one could back their currency with enough gold to get there. So probably not going to see that emerge.
Yeah. So I want to move to valuing an asset. We talk about stocks and discounting cash flows back to today's how we value a stock, or you could price it in the market with some multiple. But how do you approach gold and valuing it? There is no cash flow, there is value in the metal, but how do you get about saying this is what the price or value of gold should be?
Yeah, that's a tough one. I mean, there's I'll give you an answer at the lower end, but as far as where gold can go on the upside, that gold will go wherever investors think it should go. On the downside, we look at production, the cost of production. Right this year, it cost all-in costs for the mining companies about $1,150 an ounce. That's the cost at the mines. When you throw in the other, exploration and other overhead and certain capital costs, what it takes to run a gold mining company, that $1,150 an ounce gets up to, say, around, $1,300, maybe $1,350 an ounce. So when we look at what's the downside for gold, Well, if gold were to fall, say, below $1,300 an ounce, you would start to see a supply response. You would see high-cost producers start to cut back on production, and you would see, gold production go into somewhat of a decline at that point. So to me, that's the lower bound for gold in the current environment, roughly around $1,300 an ounce. On the upside, I mean, it's investment demand drives gold on the upside, and if you gave me it's driven by macroeconomic and geopolitical factors, et cetera. It's a financial asset, so wherever investors are comfortable buying gold is where it goes on the upside. So there is really no way to quantify, to say an ounce of gold is worth, $1,900 or, $2,000 or $3,000. There's no way to quantify that. Yeah, the last thing I'll say on that, when you look at supply and demand, so you have jewelry demand, central bank demand, industrial demand. Those are the three key demand areas for gold. And then you look at supply. There's two sources of supply. There's mine supply and there's recycled scrap supply. So it's a fairly simple equation, but when you run those numbers, those supply demand numbers, you can have years when you have excess demand yet the gold price goes down. You can have excess supply yet the gold price goes up. The price doesn't correlate with what's happening in the physical supply and demand market. What drives it is investment demand, not that physical demand. It's not like other commodities. You can look at soybeans or copper or oil, and you can run the supply demand numbers and kind of judge where the price is going to go. That doesn't work for gold. It's investment demand that drives the price, not the underlying physical demand. The physical demand is secondary to investment demand.
So we've talked about the supply, and I think it's similar to we've had discussions about the energy market, that the bear market in commodities has been so long and so prolonged. We don't think CEOs are just jumping to go ahead and increase production and take advantage of higher prices. I think they want this to kind of play out, and no one's really wanting to take the risk, especially whenever you have a lot of political risk that's involved. And I would think that would be very similar with gold. So if that's true, supply is going to probably be less than what it would be just because prices are higher, because there just isn't that need to go out and produce at the prices that they're currently at. But then on the demand side, as you mentioned investment, right? Because once you mine the gold, unlike the copper or corn or whatever, you don't use it, it just stays there. So that supply tends to grow over time. So how much of that is being demanded, and at what price to pull it from other investors' hands?
How do you look at silver in that landscape as well? Sometimes they all get lumped together. Do you approach silver differently?
Not from gold. I mean, there are only two monetary metals on the planet, gold and silver. And in my mind, the biggest driver for silver is gold. So I think silver will go wherever gold goes with leverage. I mean, in a positive market, I think silver will outperform gold and vice versa. The other aspect of silver is it's got a much bigger industrial component than gold does. So sometimes silver is more influenced by the base metals and industrial demand. So I would, gold is the primary driver for silver. The secondary driver would be industrial demand for silver.
So then on a portfolio context, kind of using gold as a part, which I could only imagine what the price of gold, all of a sudden it has to be about 1 to 2% of the average person's portfolio, right? The investment demand would really move that up significantly. But when you're looking at, gold or gold mining companies, how should you approach those two within the portfolio context? Are they suitable? Could you use one as a derivative of the other?
When when I talk about gold, as far as our price outlook and what we think the gold market's doing or going to do, the same thing applies to gold stocks. I mean, there's a very, very high correlation between gold and gold stocks. So I think the stocks are proxies for gold, and they're proxies with leverage. They'll have up to, some stocks can have 2 or 3 times the leverage to gold. So they'll outperform in a positive market. The stocks will underperform gold in a down market. The stocks carry risks. I mean, these are mining companies, and mining is risky business. And that's why, I would discourage anybody from buying a single gold stock. I mean, you should always be diversified when you're investing in a somewhat risky asset like mining. But as long as you diversify that across a range of companies, you've got an investment vehicle that performs like gold with leverage.
So one of the things that people think about, so we're both CFAs, and they would always talk about correlation. And what they're saying is something zigs whenever everything zags, and gold is supposed to do that. So then when that thinking would say, well, if markets are going to do well, gold should do poorly, or vice versa. And I don't know that it always holds true. And then the other component that people would say on why you wouldn't want to own gold is because rates are going to go up, and rates have been moving up. So this is bad for gold. Do you think that's going to hold the next 5-10 years, or are we moving into a different paradigm for gold? It's a different situation.
Yeah, no, those are great questions. I'm glad you asked that correlation question, because it's a common misconception. Gold has zero correlation with other asset classes, or roughly zero. So, with stocks and bonds and REITs and some other asset classes, it doesn't correlate. Now, a lot of people confuse that with a negative correlation. They think if stocks go up, then gold should go down, and vice versa. No, the correlation is zero. That means sometimes gold correlates with stocks and sometimes it doesn't. Over the course of time, it averages out to a zero correlation. And so you have to, with gold, you have to look at, you can't just look at the stock market and think you know what's going to happen with the gold market. The stock market isn't even a primary driver of gold. What drives gold is interest rates, especially real interest rates, the dollar, and tail risk. Those are the 3 primary drivers of gold in the macro environment. It's not the stock market. And so you have to look at what's going on in those primary gold drivers. And that's why sometimes gold will correlate with stocks and sometimes it won't. And as far as your rate question goes, the key for gold is real rates. I mean, anytime you get into a negative real rate environment, that's almost always a good environment for gold for 2 reasons. One, because gold becomes competitive with interest-bearing assets, because you're not making any money on your CDs or your bonds, so gold becomes competitive with other interest-bearing assets in a negative real rate environment. The second reason is real rates really aren't supposed to be negative. I mean, you're supposed to earn a return on your investment, right? So when real rates are negative, that tells you something's wrong with the financial system. There's stress in the system, and that stress, that tail risk, is also going to drive gold in that environment. As far as, so if rates are rising, generally gold has an inverse correlation with rates. But again, you have to look at what's driving that. If rates are rising due to inflationary pressures, then inflation can drive gold too. And so, gold can sometimes, rise as rates are rising. It just depends on what's going on, other things going on in the macro environment.
What are your forecasts for this tightening schedule? I know the market and Fed fund futures now expect Fed funds rate at the end of the year to be 2.75. Do you think the economy can handle that? Are you thinking they're gonna tighten that fast?
I don't. In my view, no, I don't think so. I think the Fed's either going to have to reverse course, put us through a recession. I think those are their two choices here. We looked at the Fed, the targeted federal fund rates and inflation historically. And if you look in the 70s, you look at like I don't remember 1989, 2007. Any time we had elevated inflation levels, the Fed has had to jack up the targeted funds rate to double the inflation rate. So that suggests that if inflation's the Fed looks at the core PCE. Of course, PCE right now is, I think, around 6%, just under 6%. That implies the Fed needs to raise rates to up to 10 or 12% to really eliminate inflation or get it down. The Fed has its work cut out for it, and in my view, it's going to come up short over the next couple of years.
I think you'd fit in well in our weekly market insight call. You have another question?
No, I think that's.
Well, then why don't we do a conclusion question? So supply and demand is ultimately what makes up all prices. Now, understanding those components is an aspect, but if the price of gold is where it is, can you make the bear case on what people are thinking about at this price, and then end with the case that I think you would make is the bull case on owning gold?
The bear case, I mean, the bear case for gold, what caused gold to trend downward for a prolonged period? I guess it's a Goldilocks or the just right scenario where the Fed can raise rates and stamp out inflation without bringing on a recession. I mean that and that's the worst environment for gold. And gold would trend lower if that actually happened. But the probability of that is incredibly low in my view. I think a more likely outcome is that gold remains at elevated levels, driven by risks to the financial system, whether it's the risk of inflation, the geopolitical risks that are developing all over the world right now, the risk of an economic downturn with this tightening cycle. What that brings is debt problems. I mean, sovereign debt is off the charts. Corporate debt is at very high levels. A lot of junk debt out there. So in an economic downturn, I think debt would become a big problem, and to the financial system, and obviously that could drive gold. So I think we tested the all-time highs back in March after the invasion, and gold has pulled back since then. I think we're going to test those highs again later this year, and we'll see at that time what's going on in the macro environment. But I think we'll test the all-time highs again later in the year, and if we get through those levels, then I think gold can go much higher from there.
So I really appreciate your time, Joe. And to kind of summarize, I think we're in agreement on just like what's the bull case for gold. Deficits are probably not going to slow. Inflation's already here and high. Geopolitical movements are probably going to be prolonged. There's questions and alternatives being created on currencies, though probably alternative currency systems like SWIFT, probably a small component to it, but will grow over time. And the price of gold really hasn't moved in anywhere comparison to the way that the Fed balance sheet has, and we're already raising interest rates and seeing inverted yield curves where they're probably going to have to back off and step on the gas in the near future. Joe, really appreciate your time and that you would join us. For those that are listening, hit that like button if you really appreciate this call. Make sure you share it with your friends if you think they'd get value from it. Always go to our website if you'd like to have a call with one of our lead advisors or one of us about your situation and whether this makes sense for your portfolio. We really appreciate you joining us, and we will see you again next week. Thanks, Joe. Thank you for watching. Be sure to like the video and press the subscribe button right here so you never miss an update. If you have any questions or would like to get in touch with an advisor, click the link in the description below to request a meeting. We'll see you next time.